Hi there, welcome to Kneppy Invest. Time to look at a company called Computershare, focusing on their financial year 22 results and looking at the relationship between interest rates and the financial performance of this company. Now, the main motivating force for me doing today's video is because I actually went to the Computershare website because this company is a stock transfer company that provides stock registration and transfer services to companies listed on stock markets, including the ASX. They also provide that service in the United States. So I went to the Computershare website to change some details of some companies I have bought, including, I think it's the address and also how my dividends is paid. So not all companies on the ASX will use Computershare. There are a few competitors, but Computershare is a fairly big company with a market cap in, I think, about $15 billion or so. But I was surprised to see, as I researched this company, how much of an influence interest rates has on the financial performance of the company. Now, to show you how important interest rates are to this company, let's go back to February 9, 2021. An article written by Yolanda Redrup from the AFR sort of mentions why interest rates are important. Now, the company did issue an upgrade, and even though they issued an upgrade, that was despite a substantial hit to the company from global interest rate cuts. So, yes, Computershare benefits from rising interest rates. And then later in the article, it mentions why. So Computershare's earnings can vary substantially with interest rates movements because it derives margin income from cash it holds on behalf of its share registry clients before dividends and other distributions are paid to the client's shareholders. So how much of an influence is rising or falling interest rates to this company? Well, they actually did mention it in a half-yearly or yearly report either a year ago or 2 years ago. And 100 basis increase in interest rates equals an increase in earnings per share of 26 cents, US dollars or US cents per share, which is quite substantial when you look at the current earnings per share this company has. So actually, let's look at the financial year 22 results to see the current earnings per share. Now, these numbers are in Australian. They actually report in American dollars, so I did have to convert this. Fortunately, there are some websites out there who will convert this for us. Current share price when I did this video, $24.75, gives the market cap of this company $14.8 billion, revenue $3.79 billion, profitable $415.8 million, and operating cash flow $717.9 million. By the earnings per share, 69 cents. So just remember, 100 basis increase in interest rates equals an increase in earnings per share of 26 cents, which is US cents per share. So this company significantly benefits from a rising interest rate environment. And that's why the PE ratio right now for this company is quite high. So you can see the market cap is 14.8 billion, yet they only had profit of 415.8 million. So that means the PE ratio of this company right now is over 30. It's actually closer to 40, which does seem quite excessive for a company that has grown, but not growing at a significant rate over the past 10 years. And as we take a look at the long-term chart, this is the weekly chart going back to 2012. The company is growing over time, but it's not growing at a significant rate when we look at revenue. However, this company, because it is affected by rising interest rates, favorably affected, we have seen a significant increase in the share price over the past few years. In fact, the share price has risen from $9 at the depths of the COVID-19 financial panic to a share price approaching 27, so almost a tripling in the share price over that period of time. You can also see the share price significantly increasing, sort of like an exponential rise in share price over the past few years, sort of coinciding with the rising interest rate environment we find ourselves in right now. Now, I've already mentioned that this company is growing, so revenues are increasing year on year. This is one of the things I do like to see, but it's not significant growth. It doesn't really justify a P ratio of around 40 or just under 40. So there has to be something else at play with this company. And that's the first thing I thought of when I saw the P ratio of this company approaching 40. What is going on? Why is the market so interested at paying a premium for this company? Well, it all has to do with margin incomes and the expected significant increase in margin incomes over the next few years because of rising interest rates. So if you look at revenue over the past 10 years, 3.6% per year rise in revenue. Over the last 5 years, 4% rise. And over the last 3 years, 3% rise. So no significant rise in interest rates in revenue. But we should expect us to see a significant rise in revenue in financial year 23 and even financial year 24 unless we see a significant decrease in interest rates. So the problem for Computershare moving forward is how beholden they are, their financial success is to interest rate environment. And if we see interest rates falling significantly from here, which is a possibility, if we do see the economies go into a significant recession, this company might see the share price fall significantly from here. Now, if you do go to the presentation, this company did release on their financial year 22 results. They spent a lot of time on margin income and how rising margin incomes because of rising interest rate environment will help this company financially. This is one of their slides. This is looking at the margin income over the past about 8.5 years. So if we go back to first half of 2019, they earned $125 million on margin incomes. That fell all the way down to $51 million in the second half of 2021. But you can see a significant rise in margin income over the past 2.5 years. In fact, it doubled from the first half of financial year 22 to the second half of financial year 22. Now to the financial year 23 outlook from the company. And now we can see why right now there is a premium to Computershare's valuation and share price with the PE ratio approaching 40. Management expects earnings per share to be up around 55%. Now that is based off some key assumptions in relation to interest rates. We'll look at those key assumptions in the next slide. But they expect margin income revenue to be around $520 million in financial year 23, significantly increasing from financial year 22. So you can just see the impact of an increasing interest rate environment on the financials of this company. Now, this company is experiencing tailwinds in relation to that significant growth in margin income driven by global rising interest rate environment. But some of the risk and headwinds in relation to this company include challenging macro environment, plus the timing and extent of rate rises may differ from their assumptions. So this guidance the company has released may be significantly lower if interest rates don't rise as the company expects, or it could be higher if interest rates keep on rising. Now on to how the company got this margin income of $520 million, and it's all based off forward-looking interest rates. And of course, we know that looking or trying to forecast interest rates in the future, the next year or so, is hard. But they expect US interest rates to go from 2.3% to 3.45%, Australian interest rates go 1.7% to 3.35% in Q4, Great Britain interest rates go from 1.65% to 3%, and Canadian to go from 2.5% to 3.43%. I think that's Canadian CAD. So they do expect interest rates around the world to be between 3% and 3.5% by Q4 of financial year 23. And you actually can see the significant increase in margin income from quarter to quarter in financial year 23. So in Q4, they had received $80 million in margin income. They expect that to increase to $110 million in the first quarter, $130 million in the second quarter, $140 million in the third quarter, and $140 million in the fourth quarter. Now onto the valuation metrics for Computershare. And the first thing I noticed when I looked at this company before I did any research on the benefits of rising interest rates to the company is I was wondering why the company has a PE ratio approaching 40. So right now, 35.7, price to sales ratio 3.9, price to operating cash flow 20.6. But just because this company does benefit from a rising interest rate environment doesn't mean you should go in there right now and buy these companies' shares, because the market is already pricing in the rising interest rates into the valuation of this company. PE ratio of 35.7. The only way you're going to benefit from a rising interest rate environment is if the rising interest rates actually beat this company's forecast for financial year 23. Now to the daily chart from Computershare. I've already shown you the weekly chart going over the last 10 years, but this is the daily chart over the past 15 months. And you can just see from May last year, the share price was around $14, how the market has really priced in the rising interest rate environment into the share price of this company, with the share price increasing from $14 to a high of $26.50, which was reached in April of this year. But that share price of $26.50 is right now a pretty good resistance level. And you can see from that high in the share price in April, share price has really just been going sideways. It's consolidating. So this rising interest rate environment and the financial success, the financial boon that this company experiences in that sort of environment has already been priced in to the share price of this company. And I don't know what's going to be happening to interest rates over the next year. I think no one does know. We could see interest rates starting to decrease in 1 year's time. And if we do start to see interest rates decrease, and perhaps if interest rates don't hit the targets that this company is expecting, we might see a significant pressure on the share price of Computershare over the next year. That's all I have for this video, looking at Computershare's financial year 22 results and the effect of rising interest rates has on the financial performance of this company. If you have any questions, any thoughts, if you disagree with me on anything I've mentioned, I'd love to hear from you. So leave it in the comment section of this video. Otherwise, I'm not a financial advisor. If you do need financial advice, make sure you seek out someone who is qualified and can speak to your own financial needs. That's it for this video. Have a good day. Bye.